Welcome everybody. This is Daniel Bennett from Advanced Portfolio Strategies. Welcome to Build for the Future today. We are very happy to have you all here and look forward to sharing some important information with you. Here are a few disclosures I'd like to draw your attention to. There are risks to investing and we cannot guarantee outcomes. I know it's formality, but it is important that we make this disclosure. Advanced Portfolio Strategies is a full-service insurance and financial services firm located in Los Angeles. We work with our clients on a team-oriented basis and always strive to give you the best professional experience possible. Creating a financial life that fits your goals, values, and needs is an incredibly important task, but in today's complex financial world, we know that charting the path to the future you desire can seem like a confusing and time-consuming process. Between dramatic headlines and contrasting opinions, how can you determine the right choices? Our goal today is to help you better understand the current economic environment and offer a few thoughts to consider when building your financial future. Of course, it would be impossible for us to cover everything, but we'll try to touch on the most relevant topics. And while past performance provides no guaranteed future results, we will focus on trends that may help guide the decision-making process when investing. Here's what we're going to talk about today. Understand stock market trends. Recognize how taxes affect your finances. Avoid potential investment mistakes. Learn methods to help preserve your assets and help ensure your portfolio fits your needs. Let's get started by taking a quick look at where we are today. If we look back over the past decade or so, it's pretty easy to see how far we've come. Between the previous market peaks in October 2007 and the bottom of the market during the Great Recession, we saw equities drop by more than half, but a decade later, the S&P 500 is more than 3 times its level in March 2009 and far above its previous peak. In the past 8 years, we've seen market hits new record highs as the economy came back to life. Markets have been on a bull run since 2009, and you may be worrying that we're due for a correction. As you can see from this chart, the current expansion is longer than the 47-month average we've experienced since 1900, but it's not the longest ever, and a number of factors continue to support our economy's strength. Since the bottom of the markets in March 2009, we've seen a lot of progress. Consider a few examples. Unemployment is at very low levels and job growth continues. The major domestic indexes have hit record highs. The U.S. gross domestic product may be accelerating. It grew 3% in the second quarter of 2017. At the same time, though, there's some things that either currently or could potentially slow further progress. The labor force participation rate continues to be low. Exports have been low for the past 2 years, in part due to slower global growth and a strong U.S. dollar. Looking forward, however, a number of federal policy changes from taxes to trade could affect the economy's strength. But with the conversations and proposals still in full swing, we cannot comment on how any changes may impact the markets. Looking at where we are today, 17 out of 20 financial indicators report positive or strengthening numbers. Since January, the global economic outlook has improved, moving from yellow to green, while geopolitical risk has turned red. 8 years into the current recovery, we're seeing signs that the global economy is picking up speed. Many central banks are beginning the process of bringing their monetary policy back to normal by winding down the fiscal choices they made during the Great Recession. After years of uneven or slow growth, the economies of both Japan and the Eurozone appear to be accelerating. Emerging economies, including Russia and Turkey, also show signs of this quicker pace. India, on the other hand, may be experiencing a slowdown in its economy. In China, growing industrial production is helping its economy begin to even out and maintain moderate growth. Still, changes to its market status and risk rating could affect the country moving forward. While we don't have time to delve into each of these areas, we will focus on ideas for building a portfolio that takes the global economic climate into consideration. Before we talk about that, though, let's first take a look at something that affects each and every American. Now we'll move on to the next section. Recognize how taxes affect your finances. Taxes. Though tax laws didn't change significantly for 2017, inflation adjustments and other small updates could affect your tax liabilities. Individual income taxes provide nearly half of all federal government revenue, and higher income earners contribute a significant portion of this money. Consider these numbers. Americans who earn more than $100,000 per year pay 79.4% of all income taxes. Those who make $250,000 or more comprise 2.7% of all filed tax returns and pay 51.6% of all income taxes. Now, we're not going to get into the politics of taxation, especially in this environment, in this presentation, and we cannot predict whether current discussions about tax reform will come to fruition. But we will talk about preparing for the current tax environment. For 2017, we didn't see any significant changes to the highest marginal tax rate, additional Medicare tax, or net investment income tax. Highest tax rate still is at 39.6% for 2017. Additional Medicare tax is 0.9%, and then net investment income tax is 3.8%. When it comes to qualified dividends and long-term capital gains, the tax rate also remains unchanged in 2017. Taxpayers in the highest tax bracket will have a 20% tax, while those in the lower brackets will be responsible for paying either 0 or 15%. The tax bracket from 10 to 15% pays 0 on qualified dividends and long-term capital gains. From 25 to 35%, you pay 15%, and those in the 39.6% tax bracket pay 20%. Just to remind you, you must hold a security for at least a year to qualify for special capital gains tax treatment. Also, not all dividends are qualified. They must meet certain IRS criteria, which we don't get into today. Non-qualified dividends are taxed at your ordinary income tax rate. The estate and gift tax exemption amount was increased for inflation in 2017. States or lifetime gifts of over $5.49 million per donor will be taxed at 40%. Annual gifts of 14% or less are excluded from these limits and are not taxed. The Affordable Care Act officially went into effect in 2014, requiring all Americans to have health insurance coverage or pay a penalty. Americans with some form of insurance coverage won't be affected by the individual shared responsibility payment. However, if you do not currently have coverage for Medicare or another qualifying health insurance, you may owe a penalty fee. Americans without Medicare qualifying health insurance coverage must pay a fine. To calculate the penalty, affected individuals would owe the highest of either of the following: 2.5% of household income up to an annual average price of a bronze plan sold through to the healthcare marketplace, or $695 per adult and $347.50 per child under 18, up to $2,085 per household. If you're worried about your health care, you want to be sure that you have the coverage you need. Bring in your paperwork and let us review it. We want to help you ensure you have the right insurance to avoid unnecessary fees and the bankruptcy risk due to insufficient coverage. For almost a decade, rules about making qualified charitable distributions from an IRA to charity fluctuated, but now your contributions to charitable causes can help you maximize your financial standing as well as your personal satisfaction. At the end of 2015, Congress made the IRA charitable giving tax break a permanent law. As a result, taxpayers at least 70 and a half years old can make charitable donations directly from their IRAs. If you are subject to required minimum distributions or RMDs, donating all or part of your RMDs directly to qualifying organizations can help you receive special tax treatment. Now we'll move on to the next section. Avoid potential investment mistakes. Life expectancy is one of the most important factors to consider when preparing for a financially comfortable retirement. Here's the good news. Americans are living longer, but this good news comes with a potential challenge. A longer life means more retirement support. So, how many years might you expect to live after your career? This slide shows this life expectancy for people who are currently age 65. If you and your spouse are this age, there is a 48% chance that one of you may live to be 90. That means if you're currently retired, you're likely got a long life ahead of you. That said, you might need 25 years or more of retirement income. So if you're only planning for 10, 15, or even 20 years in the future, there's a good chance you could come up short. For this reason, we believe that choosing the right investment strategy is essential to help you foster your financial longevity. Your plan should combine a sustainable withdrawal rate with the right measure of risk, and it must take inflation into consideration. From our perspective, balancing these factors is a powerful way to help ensure your money lasts. While discussing health issues can be difficult, it's an incredibly important conversation. After all, longer life expectancy often means long-term healthcare expenses. While Medicare will cover many medical services, it won't cover a few expensive costs which are only getting pricier each year. As of 2016, annual costs for healthcare were as such: homemaker services, $45,000 plus a year; home health aid, over $46,000; assisted living facility, over $43,000; nursing home, semi-private room, $82,000 and some change; nursing home, over $92,000. Keep in mind that these numbers represent national averages. The cost of each of us as we age will depend on where we live and what kind of care we need. And we all know healthcare costs don't seem to be going anywhere but up. When looking to the future, does your financial strategy consider the true costs of long-term care? Even if you have a well-balanced portfolio, spending too much can increase your chances of outliving your money, especially if you spend several decades in retirement. Often people hope to withdraw 5 or 6% of their assets in retirement. For some, this spending rate will be okay, but for others, it may be too high. In fact, recent research reinforces the long-held idea that spending about 4% of your portfolio each year may create a 90% chance of making your money last. As you can see from the slide, the planning horizon has a big impact on what actual withdrawal rate you can use to fund your retirement. But depending on when you retire, how you invest, and how long you live, your best withdrawal rate may be higher or lower than these percentages shown here. Matching individuals' portfolios to their lifestyle is one of the key things we try to help our clients navigate. It's why we recommend working with a qualified professional. We have access to sophisticated models and simulations that help us create strategies designed to truly fit your circumstances. When determining your financial standings now and throughout retirement, you must plan for inflation. Here's one way to put inflation in perspective. Depending on where you live and when you became a homeowner, your last car may cost more than your first house. Just take a look at how inflation has impacted the prices of critical items since 1980. A new single-family home has jumped from $64,000 to $316,000, while private college annual costs went from $5,500 to $45,000. The reality is that what seems like a lot of money today will likely have significantly less purchasing power in the future. I want every one of my clients to enjoy the retirement of their dreams, and in order to do so, we have to factor in inflation. When building a financial strategy, we work hard to create an approach that plans for your longevity and allows you to live a satisfying life. But beyond helping clients prepare for a longer retirement, we are focused on addressing a key goal: managing emotional reactions. For many investors, the market's inevitable fluctuations can make investing feel like an emotional roller coaster. However, letting erratic, short-term market movements create anxiety can lead to detrimental financial decisions. People start off confident, become euphoric, then get nervous and desperate, and then finally become defeated, which is typically the best opportunity to make money. As financial representatives, our goal is to help you gain the long-term perspective you need and avoid making knee-jerk reactions that can derail your financial future. This chart helps demonstrate how emotional decisions and knee-jerk reactions may hinder growth within a portfolio. And these choices can significantly affect a portfolio. In fact, as you can see here, over the past 20 years, the average investor earned less than half the returns of the benchmarks, like the S&P 500. Thanks to the power of compounding interest, those lost returns could mean the difference between turning an initial $65,000 in equity and $35,000 in fixed income investments rebalanced annually into $190,000 or $370,000 in 20 years. Rather than trying to chase hot stocks and predict the future, most people will benefit from a more level approach. Building a well-structured portfolio that contains a variety of investments, pursues individual objectives, and reflects personal risk tolerance is incredibly important. Now that we've discussed a variety of factors that can affect your financial life, how can you help preserve your assets and create a portfolio that fits your unique needs and goals? The answers truly depend on where you are today and where you hope to go tomorrow. But here are a few strategies we often use when supporting our clients. Your financial life is complex and includes many intertwined pieces, and we believe your financial guidance should be just as multifaceted. When supporting clients, we employed a wide variety of strategies. In fact, depending on your unique needs, we may include all of the items listed here. Tactical asset allocation, tax-efficient investments, diversification across asset classes, diversification within asset classes, alternative investments, and insurance. But please note, we are not advocating any of these specific strategies to anyone here today. Based on a number of important factors, the strategies we use for you personally may be very different from those we use for the person sitting next to you. We are sharing this perspective with you strictly for informational purposes. Investing involves risk, including the potential loss of principal. No investment strategy can guarantee a profit or protect against a loss in periods of declining value. Selecting suitable investments and the right amount of them is extremely important, and we believe this process begins with a strategic approach to asset allocation. You have probably heard of asset allocation as a way of helping protect your assets and giving them growth potential. Rather than trying to time the markets, which can be a risky endeavor, asset allocation strives to capture growth and limit risk by choosing a wide range of investments. The colored blocks on this side each represent a specific market sector, and their order in each column indicates how well it performed that year. The higher a block's location for the year, the better its performance. Do you notice something in this chart? The top performing sector often changes from year to year, and sometimes what performs best one year performs worse the next. By spreading your investments across different sectors and industries with asset allocation, our goal is to help you create sustainable performance in any market environment. Diversification and asset allocation do not guarantee positive results, however. Loss, including loss of principal, may result. We strongly believe that everyone's investment needs are unique, and we work hard to structure a custom portfolio for each client. To illustrate how we do this, imagine a portfolio that has 5 buckets. Bucket number 1 provides the income your family needs for the next 12 months. Bucket number 2 is the income that you will need for 2 years and 3 years. Bucket number 3 is the income you will need for years 4, 5, and 6. And bucket number 4 represents the income that you will need from years 7 to 10. And bucket number 5, the money that you will need more than a decade from now. Now, do you think we should be investing the money you will need for the next 12 months the exact same way as the money you will need for 11 years plus? Of course not. We need to help reduce the risk for the money you'll be using soon, and with the assets you won't need for years, we want to pursue greater growth, which may involve more risk. Our goal is to strategically invest your assets so each bucket takes on the right amount of risk for your specific goals, comfort level, and timeline. We assess your short, medium, and long-term needs and spread the money into different investments with the proper amount of risk and liquidity. In this way, we strive to ensure that you are prepared for various future phases of life. Now we'll move on to the next section. Help ensure your portfolio fits your needs. When building portfolios, we not only strive to help clients achieve their goals, we also want them to step confidently along their wealth management path. In order to achieve this, we need to understand exactly how much risk a client feels comfortable taking. Each client is unique, and what feels risky to one person may feel too tame to another. So we spend significant time getting to know our clients as people and working to define the right level of risk for their goals and their personality. It's important to know your risk tolerance. If you have low risk tolerance, you have trouble dealing with any downturn and want consistent returns even if they are low. If your risk tolerance is medium, large performance swings may keep you up at night, but a moderate amount of fluctuation is okay with you. And a high risk tolerance, even large performance swings, will not derail your investment strategy. You are steady as a rock. Once you know what level of risk you feel comfortable taking, we believe you should also decide how you plan to manage that risk. From our perspective, you have 4 potential choices: ignore, avoid, manage, or transfer risk. Think about it this way. If you choose to drive a car, you have 4 ways to address the risk of crashing. Ignore it. With this approach, you would say, if I crash, I'll just buy a new car. Avoid it. You could decide, I don't want to crash, so I won't drive at all. Manage it. You say, I'll drive defensively with my hands at 10 and 2 and hope no one hits me. Or 4, transfer it. Rather than taking on risk, you let someone else carry the burden by saying, I'll buy car insurance. When it comes to investing, you have to choose not only what risk tolerance you prefer, but also how you want to handle that risk. We often recommend using a variety of tools to help our clients transfer their risk. This may include insured investments, life or long-term care insurance, and more. Please note, though, most investments are not FDIC insured and guaranteed by any government agency. Any guarantees are based on the claims paying ability of the underlying company. Ultimately, deciding whether to ignore, avoid, manage, or transfer your investment risk is a personal choice. Our job is to educate you about your options and help you make the right decision for you. Constructing a client's portfolio isn't the end of our support. It's actually just the beginning. Both your life and the financial world are constantly changing, and we want to help ensure that your wealth support evolves too. We talk to clients regularly in order to make sure we know about any changes to their goals or circumstances. We also analyze and rebalance each portfolio to help ensure it continues to support each specific strategy and client needs. Thoughtfully and strategically planning for your legacy is one of the most important ways you can support future generations. But the reality is that from estate taxes to charitable giving laws and beyond, preparing to pass on your assets is a highly complex process. To avoid leaving your heirs with problems to unravel and to help minimize the risk of your estate landing in probate, professional support is critical. We believe that estate strategizing requires guidance from financial representatives coupled with legal and tax advice. While our clients build their legacy plans, we often connect them to local attorneys and CPAs who help ensure their strategy works as efficiently and as effectively as possible. We can also work with you to share your assets and pass on your values to your heirs. Rather than just leaving each of your loved ones with a lump sum of money, you can fine-tune the details for them. You have the power to determine when they receive access to the money, how they can use it, and even what tax consequences they face. Of course, successfully accomplishing these goals requires putting forth the effort and planning in advance. Your legacy matters, and estate strategizing is an important tool for building the lasting impact you desire. If managing your financial life feels like a complex and challenging endeavor, know that you are not alone. Ask for help. One survey found the following: 43% of people said that managing their finances feels more complex than it did 5 years ago. Only 28% said they feel completely confident they are using accurate methods to stay on top of their financial lives. Both the challenges and the strategies we have discussed today can be very difficult to balance properly. And as we have highlighted, taking one misstep may have a big impact. We are here to help you manage what you have worked so hard to earn. As registered investment professionals, our job is to help you cut through the clutter and help build a portfolio that is unique to you. At Advanced Portfolio Strategies, our goal is to help you in 4 key areas. First, analyze your current situation. Next, help you select suitable investments. Then, set realistic expectations for performance. And finally, monitor your portfolio and recommend changes over time. Thanks so much for your time today. As you can tell, we're pretty passionate about helping you understand the markets and find the answers you need. For more information and timely updates, please follow us on social media and contact us at any time. You can find all our information on our website at www.advancedportfolios.com. We hope that you enjoyed the information we shared, and we'll be around to answer your questions. Thank you, and goodbye.